Difference between conventional and Islamic banking. What is Islamic banking? It is an ethical banking system which completely prohibits interest, and its practices are based on Shariah laws. Islamic banking is an asset-based financing, and it also doesn't allow prohibited trade elements. For example, one cannot take a loan from an Islamic bank to open a wine shop, or an Islamic bank do not invest in businesses which have any element of gambling. Conventional banking system. It represents an unethical and profit-oriented system. The main purpose of conventional banking is to make money, which is mostly produced through interest. Here are the major differences between Islamic banking and conventional banking systems. Medium of exchange. In conventional banking, the financier gives money as an interest-bearing loan, regardless of how the money is used. However, the Islamic bank purchases the commodity which the client requires, such as a house or a car. Base of profits. Conventional banking charges interest on capital, and that interest depends on the time value, whereas in Islamic banking, profits are earned through exchange of goods and services. Time value of money. The conventional loan amounts keep on increasing with the passage of time, while the selling price once agreed in Islamic finance remains fixed. Deficit financing. In conventional banking, the expanded money in the money market is without the backing of real assets, and it results in deficit financing. On the other hand, in Islamic banking, the balanced budget is the outcome of no expansion of money. Sharing in loss. When a lender suffers losses in a conventional type of loan, it is not shared by the bank, whereas loss is shared by Islamic banks as an investment partner. Dispersing funds. In conventional financing, while dispersing cash finance, running finance, or working capital finance, no agreement for exchange of goods and services is made. On the other hand, execution of agreements for the exchange of goods and services is must when funds are disburses under mudarabah, salam, and istisna contracts. Inflation. In conventional banking, due to non-existence of goods and services behind the money, expansion of money creates inflation, while in Islamic banking, no expansion of money takes place, and thus no inflation is created. Existence of capital goods. In conventional banking, bridge financing and long-term loans lending are made without the existence of capital goods, whereas musharakah and diminishing musharakah agreements in Islamic banking are made after making sure that capital goods exist and before dispersing funds for a capital project. Government loans. In conventional banking, the government may obtain loans easily from the central bank through money market operations without initiating capital development expenditure, while under the Islamic banking system, the government cannot obtain loans from the monetary agency unless the goods are delivered to the National Investment Fund. Growth of a society. In a conventional system, real growth of wealth does not take place and money remains in a few hands, whereas the Islamic banking grows the real wealth of lots of people. Project failure. In case of project failure, conventional loan becomes non-performing loan, while in Islamic banking system, the management of the organization can be handed over to better management. Effect on GDP. Debts financing gets the advantage of leverage for an enterprise due to interest expense as deductible item from taxable profits. This causes huge burden of taxes on salaried persons, and so it decreases real GDP. Whereas, due to profit-sharing concept in modes like mudarabah and musharakah, extra taxes are generated for the government. This minimizes the tax burden on salaried persons, increases their savings, and also increases the real GDP. Effect on national currency. In conventional finance, net exports amount becomes negative due to decrease in GDP. This results in further foreign debts and weaker local currency. Whereas in Islamic banking, net exports amount becomes positive due to increase in GDP, and so it reduces foreign debt's burden and local currency becomes stronger. Nature of financing. Conventional financing such as lease is offered through funds having usufruct, whereas the lesser in Islamic lease provides asset and not funds, so the return is rent rather than interest.